Hey, it's Soleil, and this is episode 126 of the Orange Pill Investor. And today I want to talk about MicroStrategy ripping. Covered calls are the gateway drug to options. And what do you do when your strikes are getting pressure? So the short version of that is it's a good problem to have. So a lot of people worry about selling covered calls, especially in MicroStrategy, and for good reason, because you're limiting your upside. And in general, when I'm dealing with mining stocks or any of this other crap I've traded over the years, that doesn't bother me. But in MicroStrategy, it's pretty scary. And I am slightly annoyed that I went with 15% call away on my MicroStrategy this week instead of the 20% that I've been building in. 20% would have probably put me around 1450, close to 1500. And of course, it's halfway to Friday, so these could go to $2,000 and just completely wreck me. But I am also going to discuss LEAPS and how adding those to my portfolio has protected me somewhat. So they're definitely putting in work this week and basically doing exactly the job that I added them for. So I'm just going to take a quick look at Twitter, though. Adrian posting this meme for all the people who didn't get shook out of MicroStrategy, watching it bounce back. So all of my irresponsibly long brothers and sisters are loving it this week, and I'm no exception. And so one guy even in the YouTube was like, he posted, "Can't wait to see what you're going to do with these covered call strikes." Because I got a 1370, I got a 1380, and a 1400. And I didn't even get 1% for these two. I really wanted these to be around the 14. Oh, I didn't get a 1450. It's a 1400. Okay. Yeah, I wanted one of these to be like 1450-ish. I would have preferred they all be around 1450. But I brought them down a little bit just to get a little bit of extra premium. And of course that, turned around and bit me in the butt a little bit. So even though my account's up like 40, 50 grand, it should be up with the number of shares that I have. It should be up like, what is this one? So this is 15, 12, no, I'm sorry, 15, 13, 28, and 12. So it should be up another 40 grand, but I'll take the 20% upside, 15% up. This is not surprising at all. This is kind of how covered calls work. When MicroStrategy is down, you're making money that you wouldn't make if you weren't selling covered calls. And when it's sharply up, you are not making money that you would have made if you just sat on your hands and sold no covered calls. And I was DM with one guy, and yesterday he actually got spooked and took his covered calls off. So that actually worked out very well for him yesterday. So he was able to appreciate all of this upside. So good job there. But yeah, this doesn't really bother me. And it's possible. So I have a decision to make at the end. Will I just let maybe like this one get called away? And then I'll have 137 grand worth of buying power added here. Probably not. I'll probably just close just pay whatever I have to pay here to close this. And then maybe I'll just peel off these 13 shares. We'll see. But this is probably going to be a good segue into LEAPS, because these 3,800 strikes, LEAPS that I added, they are, it's at 164 days, 184 days to expiration. Maybe 160. I can't read it without my glasses. But sorry, getting pinged. I'm already clocked out though, so I'll have to get back to me later. All right. So I picked up these 3 leaps, and I had done some calculations. I think I would probably need 3 of these leaps to protect me, or 3 each to protect me on each one of these covered calls. So the value on these have just about doubled, which is, their purpose. And I'll make about $5,000 on this one, and that's why I'm saying 3 of these would cover the entire quote-unquote losses here. So if this is about $15,000 that I'd have to pay to roll this, 3 of these leaps, bottom for 6,500, could make about $5,000 on this. So I've got options this Friday. I can just let this get called away. I could sell some of these leaps to offset, or just roll this and pay the debit, or I could roll it, pay the debit, and sell some of these leaps to offset the cost so that they've kind of served their purpose, or I can peel off some of these extra shares. So the whole time that MicroStrategy was crashing from $2,000 down or whatever, I'm buying a couple of shares a week. I was buying these leaps. So I'm basically dollar cost averaging down with the money that I made selling the covered calls. And now I can use these shares. These 13 shares are clearing 250 in upside each. So what is that? $200 times 10 shares, $2,000. Yeah, probably another 2,500-ish profit here I could take. So we'll see. We'll see how much pain this causes by Friday. But there's nothing for me to worry about now. And actually, since these have breached my strikes, these have some intrinsic value now as well, right? So this is a 1370 strike, and the price is up to 1,500. So that's $130 worth of intrinsic value built into here. And it's still got about, what, $600 worth of extrinsic value. So that $600 of extrinsic value that's still in this option has to drain out of this option and go to me by Friday. So I'm just going to hold on to this, get my other $500 out of each of 3 of these, and then I'll deal with whatever I have to deal with. So I don't really get spooked midweek, and I calculate my profits, my risk, all of that stuff. I calculate on the previous Friday. There's no emotions involved in it. I know what the price is. I estimate where I think it could go, and then I sell a covered call based on whatever that strike is and how much premium I want to collect. And then whatever happens, happens. I really don't care. So this week, if it costs me some money to roll or to do whatever, then maybe I just won't pick up extra shares this week. I only had about, like $25,000 worth of buying power last week, and that was less than 10% of my total value. So I was way over levered, I believe. I've got some emergency funds I can deploy if MicroStrategy had taken a dump to 800 instead of 1,500. I would have had to broken some glass and grabbed some emergency funds from the piggy bank. So I'm glad I didn't have to do that, but I may actually try to pad this a little bit more even, or at least just not buy too much. And since Tesla has not come up, maybe I will sell a little bit of MicroStrategy for profit, and then I will dollar cost average back into Tesla. That's going to have another advantage for me as well, because I was trying to buy some MicroStrategy, and even though I had margin buying power, tastytrade actually denied me for concentration risk. So you can get denied if you don't have enough buying power, but you apparently, depending on their algorithm, you can also get denied if they sense that you are just way too invested. You're not diversified. That scares them, because if MicroStrategy takes a dump, then I get a dreaded margin call. And, you know, maybe kudos on them for trying to protect me from myself. I don't know. But, yeah, so the fact that I'm only up 20%, or maybe 15, 20%, and not up, what, 40, 50%, is, actually, no, it wouldn't have been 40%, like 25, 30%. You know, it would be nice if you could make a perfect trade every time, but this is good for me, and just because it's going to be good for the other guy does not bother me a bit. And I'm reminded again, and that's why I think covered calls is one of the most ethical trades. So I made $1,000, right? Then I made another 15%. I made another like 15 grand from MicroStrategy going up from where it was trading at like 1150 up to 1370. What is that, 20 grand? So I made like 10, 15, 20%, and then this guy is going to make 14 grand, and he only paid $1,000 for it. So he 10x'd this week. Now, granted, the last like 5 weeks in a row, this guy making this exact trade lost $1,000 every time. So, you know, good on him. So I made 10 grand, this guy made 15 grand, and that's one of the only trades that I can think of in the stock market where both parties can actually profit. So I kind of really like that in a philosophical way. And so it does not bother me a bit that this guy got a 10x and I only got like a 20% x, or, you know, 1.2x. That's totally fine. I'm going to do it again next week and the week after and the week after and the week after. And, you know, over time, I believe I'm going to do well, and it's been working for me. So going to keep on with it. But so these leaps have done well. They have served their function as I hoped they would. I just needed more of them. I needed about 3 of these for every covered call. And I knew that going in, but as I said, I only had about 25K buying power last week. And I'm like, I'm not using every bit of it to get these leaps. So I probably should have had, instead of buying these 13 shares at an average price of $1,200, I should have probably had that 12 grand in 2 more of these leaps. And then really, I just probably have too many shares for my account size because I'm using margin. But to make Tasty Trade's algorithm happy, I will probably start buying some other things. Maybe I'll buy some more Riot, I'll buy some more Mara, I'll buy some more Hut, I'll buy some Tesla, and just to try to like tell the algorithm like, hey man, I'm not just invested in one thing here. Like 90% of my portfolio is in this single stock. I don't know how much of that I'll be able to stomach because I believe in MicroStrategy more than any other asset right now. But we'll see. I do love Tesla, and I kind of did feel a little bit Tesla poor recently when MicroStrategy tanked. I sold off like 4 of these leaps right here. I sold like 4 of these for like 4,500, I believe, and loaded up on some more MicroStrategy. But so those are my options. I can just let shares get called away. I can sell shares to pay for the debit, or I can sell leaps to pay for the debit. This is all kind of just going according to plan. Not a big deal, really. However, let's talk about LEAPS. So LEAPS is long-term equity anticipation securities. I always want to call it long-term expiration, but it's long-term equity anticipation securities. And so what you do is you're going to be out here, and I'm an option seller, so LEAPS has very specific use cases for me. And so generally, LEAPS are like a year out, but you can kind of get away with it at 6 months. I would never hold any leaps under 90 days. Like 90 days, I really got to start looking at it. I could go to 60 potentially, but it's because of the reverse is also true. I will not sell a covered call past 60 days because under 60 days favors me, the option seller. Greater than 60 days favors the buyer. So if I'm going to buy a call, I have to look at that in reverse and say, I'm not going to buy a call under 60 days because that's an advantage to the seller. I got to buy calls greater than 60 days, so that's a disadvantage to the seller. If it's a disadvantage to the seller, it's probably an advantage to the buyer. And the reason is because the longer you get, the longer the days to expiration, the smaller theta becomes. So let's just look at some degen shit for this Friday. Theta is $14 a day, which makes sense. There's only 3 days left. 100% of this, well, let me go below the money so that there's no intrinsic value. So, no, I'm sorry, I was in the right spot. This is out of the money, so all of this is extrinsic. So 14, 15 bucks a day is draining out of this over the next 3 days. But actually during the last day, theta is going to really accelerate. So probably today and tomorrow, $30 will drain out, and then like the other 28 will probably drain out of this on Friday. So theta is going to be, 15 bucks today, but it might be 20 tomorrow, and it might be 25 the next day. The closer you get to expiration, theta has to be big enough to make all of this value disappear. So let's just go out to something like 180 days. This would be the shortest I would be willing to consider is a LEAPS. So now only $1.20 is draining out a day. So you can only hold, if you hold something that's 3 days to expiration for 1 day, $1,400 is draining out of it. But out here, only 120 bucks is draining out a day. Now let's say, that's still a shitload of money. But on a $45,000 LEAPS, that's not that big a deal. And so that's 100 bucks a day, but let's go out 583 days, was a year and a half-ish. Okay, only 55 cents is drained today, times 100, 50 bucks, 55 bucks. So as you can see, the farther out, these are getting prohibitively expensive though. But as a buyer, you want to go out as far as you can afford. And then you have to decide, do I want to go up the chain as far as possible, or to a certain extent, and get something cheaper? Or do you go to the bottom of the chain and get something more expensive? How do you decide that? And the way that I decide is, let's just take a look at my IRA. I'm also trading MicroStrategy there. However, I don't have enough money. And you can't, sorry, this is MicroStrategy. I don't have enough money. I only have 80 grand worth in here. So I can't buy 100 shares of MicroStrategy. So I wanted to trade MicroStrategy. So the only way that I can do that is to create a synthetic stock. Synthetic stock is with a LEAPS, and it has to be deep in the money. So it's going to be as far below the stock price as possible that you can still afford it. And I'm saying delta should probably be at least 0.7, but most people prefer 0.8, 0.9 even. I don't like to go to 0.9 because that doesn't give me much room to grow. So when you're evaluating your LEAPS, you got to look at your deltas. And so this is the one that I bought. It's 247 days away. And I got the 1100 strike. So the delta on this is 0.79. But when I bought it, a few days ago, the delta on this was only 0.7. So right around the 1300s, which makes sense because MicroStrategy pumped a couple $100. So I bought a 0.7 delta, which means that every dollar that MicroStrategy goes up, the price of my stock goes up 70 cents. But as the price of the stock goes up because of, is it gamma? I'm having a brain fart. But anyway, the other Greek determines that how much delta changes per change in dollar amount. So now my 0.7 delta LEAPS is a 0.79 delta. So even though I paid what I paid for it, now I'm getting almost 80 cents per dollar. I was getting 70 cents per dollar when MicroStrategy was $1,300 a share. Now I'm getting 80 cents per dollar, 79 per dollar when MicroStrategy is at 1,500. If MicroStrategy goes to 1,700, I'll be getting like 85. Like 85 cents per dollar. And so, yeah, like a 0.7, 0.8 delta just lets you grow, because I mean, if you buy one all the way here, like, you know, come on, 400 strike in, you know, LEAPS, you're not even getting that big of a discount. You're still going to have to pay $113,000 for it instead of $150,000. But you know, it's definitely a synthetic stock. You're going to get 0.96 you're going to get 96 cents for every dollar move, but you're not going to get, you know, it can only go to 1. So you're going to get diminishing returns up here. So I'm thinking 0.8, 0.85, those are pretty decent deltas. Now you can get wrecked though. If MicroStrategy had crashed at 800, I would only have like a 0.4 delta or something. So, and that's why I said before, I prefer owning shares. So I'm doing it out of necessity in my IRA because I just don't have enough money, but I'm not doing it in my regular account because I do have enough money. Now, granted, if you were very confident that the price of your stock was going to go up, this is called a poor man's covered call, when you combine a deep in the money LEAPS and then you sell covered calls against it. It's all kind of like a calendar spread, because you're buying something that's like 6 to 12 months out, 18 months out, whatever, and then you're letting the low theta stock depreciate slowly, and then you're selling the high depreciating theta week to week, or out to 45 days, whatever. But it's pitting those two values against each other is what can let you make some money. And so that is one use case for LEAPS. Deep in the money, it allows you to trade as if you owned the stock. You can use it as collateral, but the risks are insane. So I was trading Tesla end of 2020, was it 2021? Well, we'll frickin' see when we check the chart here. I was trading Tesla back here. Oh no, way before that. When did it peak? Yeah. End of 2021, right? So I had a ton of poor man's covered calls, and I was just patting myself on the back. Back here, I was selling covered calls, and I'm like, wait a minute, I can make more money as Tesla's going up. I can make more money with these poor man's covered calls. So I was just raking it in, right? Like I tripled my account in like a year and a half. And so I'm like, okay, I'm happy with all the gains, but it didn't occur to me that when this started to shit the bed and the Fed was raising rates and I didn't realize what was going to happen. So just like leverage when number go up is awesome, leverage when number go down is not awesome. So as Tesla crashed from 400 to 300, right? You would think, oh, okay, I lost 25%. Like, no. When you lose 25% on share value, your LEAPS are going to lose 75%, or 50%, I mean. And when your share value, goes down 50%, you're going to lose 75%. And so I kind of figured it out by the time I got to like here somewhere. I had lost 75% of my account, and so I was patting myself on the back for 3xing my account, and then I was crying in my beer because these poor man's covered calls, these LEAPS, was leveraging me in the wrong direction. So that's why right now 10% of my account would be about 34 grand, and these are worth about 30. So yeah. And last week these were probably only 5% of my account. They're only 10% of my account now because they're pumped. And actually, now that I think about it, I may want to trim some of this because I don't know if I feel comfortable having more than 10% of my account in LEAPS. We'll see. But what's the other use case? So if there's a use case for going deep in the money, is there also a use case for going deep out of the money? And clearly there are, because these deep out of the money 3,800 strikes that I bought in November have now tripled up. Or excuse me, doubled up. And one of the benefits is they're just cheaper. But one of the benefits is so that the delta is going to be small, and then this delta is going to get bigger as the price of this stock goes up. So you're kind of like, it's kind of compounding and just gaining momentum, I suppose. Yeah, it is gamma. So I'm buying these as kind of a hedge against. Well, it's not even a hedge against. Some people just buy these on their own because if the price pumps, you just make a shitload of money on these things. As I said, Delta is going to grow and grow and grow, and eventually, if MicroStrategy ever got to 3,800 a share, which, not financial advice, but wouldn't surprise me by the end of next year to completely eclipse this. But when it does, now Delta is going to be like 0.7, 0.8. So instead of getting a double up, these would probably be like 4x, 5xing. And do I still have options profit calculator up? Yeah. I got to generate it again. So this is a good tool. And let's buy what did I buy? November? And I bought the 3,800 strikes. Let's just hurry up and calculate. So if the price went to 38.50 by like, yeah, let's just say by September or something ridiculous. So now I can make 60 grand profits. Yeah, so these are like 10, 12x. So, that's the benefit. But it's kind of like a YOLO thing. But if you have confidence in Bitcoin, like me and my Bitcoin maxis do, then you probably have confidence in MicroStrategy, like my irresponsibly long brothers and sisters do. And this is less YOLO than it may seem. No guarantees, but this is how this works. Now, here's the other thing, though. So if MicroStrategy gets to 3,800 well before my expiration date, that's when you make a whole bunch of money. But if MicroStrategy is at 3,800 at expiration, I lose $5,000. And that's the point, is you're not really supposed to hold options to expiration. You hold options until there's a point at which you know, anywhere in this green, you can make money. So you can see you want to sell it as soon as you have made the profit that you think you should make in this LEAPS. So it's definitely a long asset. You're hoping that the price of the stock doesn't just go up $10 a day. Like you want it to go up $200, $300, $400 a day, like what happened in MicroStrategy here. And I've started stacking some in Tesla as well, because I feel like there's going to be some news and Tesla's just going to gap up. And so my strikes are just going to get wrecked at some point. I'm not really even making a lot of premium on these Tesla covered calls, but I love Tesla so much I can't help myself. So I'm starting to stack these LEAPS in Tesla, and I got like 2 years on these. I went all the way out to June 18th of 2026. Yeah. So plenty of time for them to unveil robotaxis, approval of full self-driving, Cybertruck ramping. They're going to have to, nobody really talks about Tesla as much with Bitcoin, but they own a bunch of it, and FASB fair reporting they're going to have to do in December or January, something like that of next year. So their earnings are going to reflect their Bitcoin appreciation. And there's going to be some surprises. There's going to be some news, and everybody's going to be like, holy crap, I love Tesla again. Like everybody's shitting on Tesla right now. But the semis are going to ramp. The 25K vehicle, they're going to be pumping these things out like mad at some point. So people will get on the Tesla train, and I will have been stacking these LEAPS in the meantime. So LEAPS are just, you know, they're speculative, number one, but as I'm selling weekly premium, I can stack up on these long LEAPS and that have low theta, and I can just hold on to them. There's not a lot of value draining out of them. And then when some pumps happen, I can take some profits. Or as I said, you buy the deep in the money ones, and then you sell covered calls against it, just as you would, to a certain extent, just as you would owning the shares. So you do have to be a little bit careful with this. And my rule of thumb, if you are going to do a poor man's covered call, if you're totally confident this is a bull market and it's number go up time, that's when this makes sense. Or like in my IRA, and I just kind of don't care because I'm not going to have access to it for 10, 15, 20 years anyway. So my LEAPS has a this is 78 delta. This is 0.78. When I sell a covered call against it, and this one went upside down on me even. I built like 20-something% call away on this one. So this will be interesting to see how much this cost me to roll. I may have to readjust my LEAPS even. But generally, I will try to get about 1% of the LEAPS value And so my LEAPS value last week was like 50, about 6 grand. I can't remember exactly. So I was trying to collect 1% off of that. And generally that will build you enough call away value to make this a fairly safe trade. And so a covered call can suffer infinite losses. So you just want to make sure that this has a high enough delta to compensate for any losses that you could get in the covered call. So you don't want to have like a 0.7, 0.8 delta LEAPS for your poor man covered call and then be selling at the money covered calls. You know, you can get a shitload of premium for that, but the value of your LEAPS will not appreciate fast enough. Because at the money, your delta is going to be about 0.5. So if it pumps, you're going to be losing 50 cents on a dollar at first. And then as this starts to get in the money, it's going to start looking like this. So now I'm losing 67 cents for every dollar that this goes up. I'm gaining 78 cents, but now I'm losing 67 cents per dollar. And as the price of MicroStrategy got closer to like 2 grand, if the delta on this starts to get closer to the delta on this, that's when you can get into trouble. So when you own 100 shares of stock, you can sell a covered call anywhere you want because your shares could get called away. It's just defined risk. It's not a big deal. When you start creating synthetic stocks, you have to measure your delta, measure the delta of the covered call you're selling against, make sure that you have a ton of call away value built in here so that you don't get wrecked. And so this is actually going to be more interesting than what's happening to me in my main account to see if I can actually, between selling off my HUT and these 13 shares of MicroStrategy, yeah, I should be good. Whether I'll be able to retain this LEAPS or not. So we'll see. That'll be interesting. All right, so that's how I manage my covered calls when they start to breach my strikes. I mostly just don't care, and I'll either let the shares get called away or I'll sell some stuff off to pay for it, and I will party and celebrate because my account's up. All right, we talked about LEAPS, and you know, for some people, this may scare them off from covered calls, and that's totally fine. I've been doing this since 2020, and it's just par for the course for me at this point. But yeah, it would be nice if you could make a perfect trade every time. But it kind of just reminds me of why I do this as well, because I'm locked into selling high here. Like the cost basis on my shares is $12.28. So I'm locking in 10% profit here. I'm not saying, oh, I wonder when I should take profits. Like, nah, I'm taking profits here. And I do it mechanically. I do it without emotion. And I think that's one reason why a lot of people lose money in the stock market is because they're trading with emotion. And for me, selling covered calls just takes that out. If I make 10, 15% this week, great. If I don't, I'll just sell another covered call and load up on some more shares, load up on some more LEAPS. So I think it kind of helps with the buy low, sell high mentality. And that's why it's my favorite trading strategy. And that's why I think that selling covered calls is kind of like a gateway drug into options. I started selling options. I think that benefited me because a lot of people just want to go straight into the LEAPS. They want to just buy these, or they'll go into the even worse than buying LEAPS. They'll buy shit for this Friday, like, oh, MicroStrategy's up, so it's going to keep going up, right? So I should just YOLO into this buying these calls here 2 days from now, and then MicroStrategy takes a dump or whatever, or just really just doesn't do anything, or goes up just enough for you to not make money. It can go up and not make money on your long call that you bought. So I like to think that I learned how to trade options the right way and in the right order. And I do use LEAPS, but I still kind of have like a deep mistrust of them. And I think for good reason. You can get wrecked with them. You can make a shitload of money with them, but you can also damn sure get wrecked. And what is the saying? The stock market can remain irrational longer than you can remain solvent. So always trade, within your bankroll. Make sure that your positions are sized appropriately. This 10% right here kind of starts to make me a little nervous. Not too nervous. I'm not going to do anything drastic, but when LEAPS were 75% of my portfolio, and the Fed decided to bend us all over, I learned a harsh and valuable lesson. So I'll leave it there, and be good, y'all.